For UPSC and beginner level understanding, think of GDP like this. Imagine a village. Suppose a village has only 3 producers in 1 year. Farmer produces rice worth 5 lakh rupees. Tailor stitches clothes worth 2 lakh rupees. Carpenter makes furniture worth 3 lakh rupees. Total value produced in the village: 5 lakh rupees plus 2 lakh rupees plus 3 lakh rupees is equal to 10 lakh rupees. This total value of all final goods and services is called GDP. How is GDP calculated in India? The Ministry of Statistics and Program Implementation, MoSPI, through the National Statistical Office, NSO, calculates India's GDP. They collect information from thousands of sources such as factories, farms, banks, shops, construction companies, government departments, railways, airlines, hospitals, schools, IT companies. They estimate the value of everything produced across the country. India mainly uses 3 methods. 1. Production, value added method. This asks how much value was created while making goods and services. Example: farmer sells wheat is equal to 100 rupees. Flour mill buys wheat and makes flour is equal to 150 rupees. Bakery buys flour and makes bread is equal to 200 rupees. If we simply add 100 plus 150 plus 200 is equal to 450 rupees crossmark, double counting. Instead, calculate only the value added. Farmer is equal to 100 rupees. Flour mill is equal to 50 rupees. Bakery is equal to 50 rupees. GDP is equal to 200 rupees white heavy check mark. 2. Income method. Add all incomes earned from production. Wages to workers, rent, interest, profit. Example: wages is equal to 80 rupees. Rent is equal to 20 rupees. Interest is equal to 30 rupees. Profit is equal to 70 rupees. GDP is equal to 200 rupees. 3. Expenditure method. Add all spending on final goods and services. The formula is GDP is equal to C plus I plus G plus XM, where C is equal to consumption by households, I is equal to investment by businesses, G is equal to government spending, X is equal to exports, M is equal to imports. Example: consumption is equal to 100 rupees. Investment is equal to 40 rupees. Government spending is equal to 30 rupees. Exports is equal to 20 rupees. Imports is equal to 10 rupees. GDP is equal to 100 plus 40 plus 30 plus 2010 is equal to 180 rupees. How often is GDP calculated? Quarterly, every 3 months, annually, for the full financial year. Easy way to remember. Think of India as one giant company. At the end of the year, the country asks, what is the total value of all final goods and services produced inside India's borders this year? The answer is India's GDP. For UPSC, remember these 4 points. GDP is equal to value of all final goods and services produced within India, calculated by the National Statistical Office, NSO, under MoSPI. 3 methods: production, income, and expenditure. India publishes quarterly and annual GDP estimates.